So we're going to dig into one of these industrial real estate stocks that is performing quite well. Before we do, please take a minute and check out the link you see on your screen for a message from our sponsor, The Motley Fool. You can get the top 10 stocks to buy right now, and it's the best way to support this work we're doing on our channel. So STAG Industrial, it's an industrial REIT, as the name implies. They own warehouse spaces, fulfillment centers, things like that. The stock has produced a 15% total return for the year so far. That's right in line with the S&P 500, which might not sound too extraordinary, but the S&P, or not, the real estate sector itself, is flat for the year. So it's handily outperforming most real estate stocks. And if you look at the recent results from the company, there are some clues as to why. Same-store net operating income is up 4.5% year over year, and that's in a pretty difficult growth environment. Occupancy is still pretty high. It's about 98% occupied. And here's really the reason that I see is encouraging. Industrial rent has just soared over the past few years. In the third quarter, STAG reported cash rent change of 28% on new leases. That includes renewals. That's an all-time record. And of those leases, 80% were renewals. It had an 80% retention rate. I promise you, Tyler, if I owned an apartment community and told all my tenants I'm going to raise your rent by 28% when your lease expires, I wouldn't get an 80% retention rate. So it's a very strong market. But what am I missing here?
Well, everything that you said is absolutely right. And, the industrial real estate sector in general has been the strongest point of the real estate sector for this year, for the past several years. If you want to lump in self-storage into industrial, it bolsters the case even more. But just, you and I have talked a lot here, offline channels and other conversations of like industrial real estate just being in this place where these combinations of nearshoring, reshoring of, supply chains after COVID, kind of realizing, holy crap, we need to, have some redundancies on our systems when supply chain disruptions start to happen. You had that. You have higher penetration of e-commerce, which means that you need more inventory distribution kind of away from storefronts, and a couple other things that have just made the need for industrial real estate, whether it be warehouse distribution or some light manufacturing. It's just been a booming time in the United States in general. When it comes to STAG specifically, here's the one thing that I've never quite been able to figure out, and it's a thing that has confounded me for a very, very long time, is it seems to me that STAG, relative to so many other players in this industry, trades at a pretty significant premium, is what I would say. And what I mean by that is if I'm looking to buy real estate related sort of REITs or anything like that, I'm looking for income plus growth, right? There's going to be a decent dividend yield to it, and it's probably going to grow at a pretty good clip because, like you just said, we have year over year rental rates or releasing rates going at extremely high levels, and so you'd expect accelerated growth in that end, more cash flow, which means higher dividends to your investors. And that's where the STAG story kind of doesn't make as much sense. Over the past 5 years, STAG Industrial's dividend has actually only increased by 3.5%. I want to make sure I get that right. 3.52% over the past 5 years total. And so that to me says it's a relatively low growth payout for the relative to so many other companies in this industry. And yet at the same time, STAG Industrial's dividend yield is somewhere around 4%. Now, typically, if I'm looking to make an investment, and I know dividend yield isn't everything when it comes to stocks, but these are real estate companies. They have to pay out their income in dividends. Because it's been so flat and it's been relatively, the yield has been relatively so low for a long time, that doesn't seem like it seems like a mismatch to me. Like, why would I pay for a modest dividend, 4% in a high interest rate environment isn't great. But why would I want a dividend that low if it's going to grow at such a slow rate? If the dividend, if I'm buying for yield, if I'm buying for dividends, and it's that low, I'm going to want to see a little bit more growth. And that's just something that we haven't seen at STAG Industrial for a very long time. And that's one of the things that, for me, I've been very hesitant to want to really jump into STAG, and for that very reason.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by nearly 4 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 504% as of September 8th, 2023, and are measured against the S&P 500 returns of 130% as of September 8th, 2023.